Alright, page 206, recording closing entries. Alright, accounts are used to accumulate the information from one fiscal period to the next. Those are called your permanent accounts. Alright, they may be called real accounts, but these are going to be your asset, your liability, and your owner's capital account. The ending account balances of permanent accounts for one fiscal period are the beginning account balances for the next fiscal period. Accounts that are used to accumulate information until it is transferred to the owner's capital account are called temporary accounts. Temporary accounts include the revenue, expense, and the owner's drawing account, plus the income summary accounts. These temporary accounts show changes in the owner's capital for a single fiscal period. So when you get to the end of the fiscal period, the balances of the temporary accounts are summarized, transferred to the owner's capital account, and then these temporary accounts begin the new fiscal period with zero balances. Okay, that's at the top of page 206. Okay, journal entries are used to prepare temporary accounts for the new fiscal period are called closing entries. Temporary account balances must be reduced to zero at the end of each fiscal period. So we're going to do the closing, we're going to record the closing entries, and then when we post these in our general ledger account, you'll see how these go down to zero. So you need to know what permanent accounts are, what temporary accounts are, and you need to know the difference between adjusting accounts and closing accounts, or closing entries. Sorry, adjusting entries and closing entries. Alright, that was all on page 206. The income summary account is what we're going to use, and the explanation for this is page 207. A temporary account called the income summary is used to summarize the closing entries for the revenue and the expense accounts. So we're going to close the revenue or the sales account to income summary. We're then going to close our expense accounts to income summary. The difference is going to reflect income or net loss. That is shown on page 207. There's not a balance side. Okay, income summary, and you need to know this. You will have probably one exam, maybe two exam questions. If income summary, when you do the closing entries and you look at income summary, if you look at the credit side, revenue greater than expenses, okay, so if you have a credit balance, then that means you had net income. If you look at income summary after you do your adjusting and closing entries, and it's on the debit side, okay, that means total expenses were greater than revenue. So if income summary has a debit balance, then you have net loss. Okay, so that's probably one or two exam questions. Alright, if you look at page 208, 208, 209, 210, and 211. These are the four different things that we have to do. The first thing you do is you close, on page 208, you close the entries for an income statement accounts with a credit balance. And if you look at the green box, sales has a credit balance. So your steps at 208, closing entry for an income statement account with a credit balance, you're going to close sales. So that is the first thing that we're going to do. Alright, this is what we did in Work Together 8-1. Now we're on the closing entries, so of course we're going to write closing entries. Our date is still July 31st. Now we're going to close sales. Sales has a credit balance. So to close sales, to bring it to zero, we have to debit. So that means sales is going to go first because we do debits first. So our sales had 5511. If I can key 5511. And we close our revenue accounts. We're going to close that to income summary. So if we debited sales, we have to credit income summary. Alright, that's page 208. That is closing entries for an income statement account with a credit balance. Page 209. we now have to do our closing entries for income statement accounts that have debit balances. If you look at the green box, page 209, that means that's our expense accounts. So we're going to close our expense accounts. Expense accounts have a debit balance, so we will close them with a credit, which means we have to debit an account first. So on the 31st, do you remember income summary is our summary account? Okay, so income summary is going to be the debit. But I'm not going to put an amount here. I'm going to go down to show you. The first one that we're going to have to close is advertising expense. And remember, that's an expense account with a debit balance, so we have to close it with a credit. And it had $821. Our next expense account is insurance expense. Again, we have to close an expense account with a credit. Insurance expense was $300. Our next expense account is miscellaneous expense. We have to close it with a credit. Miscellaneous expense had $347. And the last expense account that we had was supplies expense. And that was $713. Now what you're going to do is you're going to add up these four. 821 plus 300 plus 347 plus 713 gives you what you are going to debit, 2181, to income summary. Okay? Alright, the third step is, let me look, page 210. You have closed sales to the income summary. You have closed expenses to the income summary. And this is where, if you remember on page 207, which side is your balance on? That determines net income or net loss. Alright? Sales is greater than your expenses. Sales is greater than expenses, so you have net income. Therefore, you have a credit balance on the income summary. And you'll see that when we actually post these. So now we're going to close income summary, which is on page 211. The difference between 5511, sales minus expenses, okay, the difference between that is what will be our amount. So we had a credit balance. Okay, we had a credit balance in income summary. So we're going to have to debit income summary to close it. And the difference, 5511 minus 2181, is 3330. Now that's net income. Net income, hopefully you know, increases the capital account, which we have Darlene Wong capital. So we will credit 3330 to capital. That increased the capital account. Okay, the 31st. Our last step is page 211. We now have to close the drawing account. The drawing account has a debit balance, so we will close it with a credit. So that means we will use Darlene Wong capital as our debit. And the amount that we had in our drawing account was $2,100. And debit will reduce capital. Net income increased capital, but all the withdrawals that they made reduces that account. So then we have to close Darlene Wong drawing with a credit. Alright? So that is our journal entries. And now we have to post these. So we have a few more postings to do right here. I know you know how to post these, but when we start walking through these, you'll see how these zero out. So I'm going to go down and find sales. Okay, the 31st. Okay, it is coming from General Journal, so G4. And sales was a debit, so 5511. Okay, so I had a credit balance, so that brings my balance to 0. And I don't know if you put 0 in, let's see, type a 0 in both the debit, okay, in both the debit and credit columns. So a 0 goes here and a 0 goes here. Okay, so now sales has been closed. We posted that to 410, so let's show that we posted it to 410. Alright, so now we have to post income summary. Alright, so we are on July 31st, G4, and income summary was a credit, so 5511. So it means we have a credit balance of 5511. Show that you posted it to 330. Okay, next we're going to have to post income summary again. So I can just say right here, income summary, G4. And this time, income summary was a debit of $21.81. And this represents our expenses. Okay, so $21.81, you can see I had a credit balance, so $55.11 minus $21.81 leaves us a balance of the $33.30. Show that you posted that to 330. Okay, now we have to post to advertising expense. $31st, G4. Okay, advertising expense was a credit to close it, so $821. And right here you had a debit balance, you have a credit, which brings this to 0 and 0. Show that you posted it to 510. Insurance expense is our next one. Okay, the 31st, G4. Alright, we had $300, which was a credit, so I'm going to put $300 here. We had a debit balance, and expense has a debit balance, and so now it's 0. So remember to put 0 in both of those. Go back and show that you posted that to 520. Alright, the next one's miscellaneous expense. If I can find... $31st, G4. Miscellaneous expense was $347 as a credit, so $347 brings us down to a 0 balance. So this one is closed. Show that you posted it to 530. The last one that we have, supplies expense. For some reason I have a hard time getting this to go down. Alright, I'm going to pause this while I try to get this supplies. Alright, I had to widen the screen a little bit. Supplies expense, 31st, G4. And we had a credit of $713, which brings our balance to 0. Okay, and show that we posted it to 540. Alright, now we're ready to post the income summary. This is your net income in this case. So we need to go to income summary, 31st, G4. Alright, we had a debit to income summary of $3,330. So, alright, so now that closes we put a debit in, we had a credit balance, so now we have closed income summary. 330. Now this, remember, just summarized our net income. Sales, expenses, the difference is, in this case, net income. And you can see where the credit balance, you had 5511 from sales that you recorded. The difference after you recorded the expenses left $3,330, which reflected net income. Because if you have a credit balance on the income summary, it represents net income. If you have a balance over on the debit side, that means you have a net loss. Alright, 330, did we post? Yes. Alright, so now let's go to Darling Wong Capital. Wong. Alright, 31st. G4. Alright, so we have a credit. This was our net income of $3,330. So we had a credit balance. We're going to add the two numbers together, which gives us $98.73. Show that we posted that to 310. Alright, now we're going to post when we close out the drawing. So again, it's going to be to Darling Wong Capital, the 31st, G4. This time we have a debit of $2,100. A debit reduces the capital, so $98.73 minus $2,100 gives us $77.73. And that's the wrong place to put that. It is your balance, so 7773. Alright. Show that you posted it to 310. And now you have to post to the drawing account. $31st, G4. Okay, drawing was a credit, $2,100. We had a debit balance, so it brings that to 0. Okay, so that's how we do our closing entries. Okay, the book is very helpful. It's easy to follow. You do need to go in that order. You need to close your income statement, credit balances, income statement, debit balances. You close both of those to income summary. Income summary summarizes whether you have net income or net loss. You will then transfer that amount to the capital account. And then you have to, that would be considered closing the income summary account. And then you have to close drawing, and that is closed directly to the capital account. Okay? Let me know if you have any questions.